Today we're going to look at what the true cost of paying cash is compared to borrowing money against an insurance policy. You've heard us talk about it on the podcast a lot of times that we finance everything we buy. We either borrow money from a bank or financial institution and pay them interest for the privilege of using their money, or we pay cash and we give up the interest on our money. Now, that's sometimes hard to wrap our brain around. Today we're going to look at the black and white, the math, or I guess today it's going to be the blue and the gray, but you get the point. We're going to look at an example of someone saving $20,000 a year that starts off with a $50,000 balance in their account. So they got $70,000 in year one, and they're going to do this for 30 years. I know you're going to say, Russ, I put in way more money than that. I'm just trying to give a generic example. So following. All right. We have to have a baseline. I know that we're not going to keep this money here the whole time, but our money's going to go in this account before it goes somewhere. So this helps us see what happens when we make one decision versus another. So first we got to give the bank some sort of interest. They don't really give us any, but I'm going to give them the benefit of the doubt. And let's say over the next 30 years, they gave us 3% interest. That's more than fair, right? How much money would we have? Well, first, the government's going to come in and say, no. You don't get to keep all of that. That's interest income. We got to get our roads built, right? We got to pay these politicians. We got to be able to send kids to school. We're going to have to take 30% off the top. So they take the 30%. Let's scroll down to the bottom. How much money we've got? We've got $935,000. Okay. What are we going to do with this money? How are we going to see its impact? So if we want to see what the cost of paying cash for something is, we could look at buying a car, buying a boat, going on vacation. But this is a passive income podcast. What are we going to look at? We're going to look at buying something that actually puts money in our pocket. So let's look at a rental property. Let's say $50,000 is what we're going to spend to get this rental property. That may be for $1 million apartment complex. It may be a $200 duplex, or maybe just a $50,000 small urban house, single family. Doesn't really matter. Let's first isolate the 50 grand. What does it cost me just to take the money out? Before I start getting in the rental income, what does the $50,000 cost? So if I spend $50,000, I was gonna have $935. I should have what? $885, right? That's how much money I should have if I took $50,000 out. But that's not what I have. I've got $841,500. So let's round that up. I have $842. So how much did it really cost me to buy the rental property, just the cash part, before I factored in the rental income? Did it cost me 50 grand? No, it cost me $93,000. So $43,000 was lost interest. It doesn't matter what I spent this money on, that money could no longer be compounding for my benefit. You see, that's what we were talking about. You finance everything you buy. Well, let's go back and say, all right, this infinite banking concept is about taking the payment, either that I would have had to pay to somebody else or I was making because of doing it this way, and injecting it back in my account. So if I was using just this savings checking account, right, which is earning way more than they are right now, and I could get $500 a month. I've already done the math. That's roughly a 13.27% return on my investment. I get that money, I shove it back into my checking savings money market account, right? $500 a month over this 30-year period of time. Where do I end up? I end up with $1,094,000. Awesome. So now you can kind of see, what did it cost me? Down here at the bottom, you can see I got back 180. I took out 50. So 130 is what I put back in over and above my 50. Well, man, that's pretty good. I had 935 initially. I put in an extra 130. You see how compounding interest works. Even though I took 50 out and I lost the compounding on it, I slowly was getting it back and then some. This is why Nelson Nash talks about why banking works. Banking is. It applies in all aspects. If we can get the power of compounding working for us, if we can harness it, then we actually have something. So we've isolated the cost of paying cash. We isolated the benefit of compounding interest. Let's throw in one little more caveat before we jump off here. What if we use an insurance policy to do the same function? What are some of the things that will differ? Well, for one, we don't have to pay these ongoing taxes within our insurance policy. These policies grow without taxes. And if we access the money for what we put in, or we access it in the form of loan, we don't have to pay income on the withdrawal or loan of that money. So I can do away with that. You automatically can look down here at what sort of impact that has on the account. It adds almost $180,000 just in the taxes on that money. That's huge. It's so big. This is a key thing. We got to protect our money from governments, taxes. We got to protect it from others, creditors, and we have to protect it from loss. Hence the reason why we use these whole life policies. But these insurance companies do charge us interest. Most of them right now has a loan rate of 5%. If we borrow the money, they're going to charge us 5%. I want to show you how that works. So first we need to go in here. We need to grab an insurance example. And I'm going to change these numbers in here so you can see this is what an insurance policy would look like. If I dumped in $50,000 up front, $20,000 ongoing, I'm not going to have all 70 grand in access. I'm only going to have access to $61,500. Can I buy a $50,000 rental property? Well, yeah, I can. I got $61,000. So I go in here and I do that. I buy this rental property, even though I don't have the full 70. I got the $50,000. Am I going to take it out in the form of withdrawal? I could if I wanted to, but then I would give up the power of the growth of the money. So I go over here, I make a loan against the insurance policy. So I pay the insurance company 5%. I've got the rental property kicking out 13.27, so I got some margin there. At the end of 30 years, I've paid off the quote-unquote loan back to the insurance company, if you will. I've got 1.464. How does that compare to my cash account? Not too bad. What is that, about $370,000? Yeah. That's an amazing difference. And what did I do? Did I take any more risk? Did I work any harder? Did I have to pay any more in taxes? No, actually I had to pay less. What did I do differently? I just created an account that I own and control, that I'm an owner. I receive the dividends. I receive the growth. I can access it and use it. Now, imagine me doing this process over and over again. What could that extra money be doing for me and my family? I didn't even talk about the death benefit that would come along with this, did I? That's another discussion. Hope this helps you see the true cost of cash. Also, what does it cost us to use an insurance company? By the way, just so you know, if I did make a zero to the insurance company, if they didn't charge me, my account would be bigger. But still, paying them interest is much larger than having the option of no option of having that and only having to do the cash. Have a great day.